Now that we've taken a look at financial statements and how they're related with each other, let's take a look at some of the underlying concepts of how accounting information is developed. First of all, we have to remember that accounting is a system. And what we mean by a system is a series of policies and procedures and other subsystems that are all brought together so that it can collect, process, and communicate information. We want to do that so that users can take that information to make good decisions. But in order to make good decisions, that information must be relevant to the user. In other words, what we're saying here is that the information should be related to what the user needs in order to make a decision. Also, the information needs to be reliable. By reliable, we mean that it's accurate, that it's free from material misstatements, and that the information being presented is accurate so that we won't make a mistake. And finally, the information needs to be comparable. And what we mean by comparable, as we spoke in the last video, is that we want to be able to take this information and compare it to the company's other periods, or to industry averages, or to its competition. Now the question is who makes these rules that we follow that we call generally accepted accounting principles? First of all, generally accepted accounting principles are a set of rules and practices that have been pretty much accepted by the business community. Now, someone has to make those decisions in terms of what are those rules. So here on this screen, the standard setting bodies are the SEC, the Securities and Exchange Commission, the FASB, the Financial Accounting Standards Boards, the IASB, the International Accounting Standard Board, and the PCAOB, the Public Company Accounting Oversight Board. You may have heard of the Securities and Exchange Commission in the media. Whenever there's any financial scandals, it is the SEC that enforces the rules on publicly traded companies. Publicly traded companies are required to follow generally accepted accounting principles and any rules that are developed by the PCAOB. The PCAOB was created by the Sarbanes-Oxley Act of 2002. This body creates the rules and regulations for accounting for publicly traded companies. If a company is not publicly traded, the rules for accounting are created by the FASB, the Financial Accounting Standards Board. Because we are now headed towards an international focus with our accounting rules, the International Accounting Standards Board was created by member countries to create international rules that will turn into GAAP. The Financial Accounting Standards Board has always taken the position that the information provided in financial statements must be relevant and it must maintain a faithful representation of the actual transaction. What we mean by that is that relevant information is meaningful to the decision-making process, whereas faithful representation means that the information or the values within the information are accurate. Now, it doesn't mean that all the information will be correct. However, the material items will be accurate. As part of generally accepted accounting principles, we need to follow a series of principles and assumptions of accounting as we process information. First of all, when we recognize a transaction, we use the measurement principle, sometimes known as the cost principle, in valuation of the transaction. One of the important parts of accounting is that we can prove every number on the financial statement, and we can only prove what we pay for something, its cost. We can come up with an estimate of value. However, we can't rely on that estimate of value because it's merely an estimate. We recognize revenues using the revenue recognition principle. And the revenue recognition principle basically says we'll recognize revenues under one of two situations. One, if we use the cash basis of accounting, or the other is whether we use the accrual basis of accounting. The cash basis of accounting tells us to recognize revenues when we receive cash from our customers. The accrual basis of accounting tells us that we recognize revenues when we earn the revenues, not when we receive the cash. Generally accepted accounting principle tells us that we must use the accrual basis of accounting for financial statements that will be presented to outside users. Now, if we're going to recognize revenues, we also need to have a principle to tell us how to recognize expenses. The matching principle tells us to recognize expenses at the same point that we recognize the revenues. Therefore, if we have the revenue recognition principle using cash as the basis of revenues, the expense would be recognized at the time that the cash is paid out. The accrual method of recognizing expenses would rather match the expense with the revenue, and it's when the expense has been incurred, not when the cash has been paid out. The next is the full disclosure principle. This principle tells us that we need to make sure that we fully disclose all material transactions in the financial statement. That means either the number should show up on the 4 financial statements or it should be disclosed in the footnotes. The next is the going concern assumption. Just like individuals, companies are believed to continue on in its lifespan. In other words, just because we come to the end of a fiscal or annual year, the company doesn't stop. Its life is going to continue on. Next is the monetary unit assumption. This assumption means that we express everything in currency, not in quantities or some other measure, only in currency. That's the reason why when we were looking at financial statements, we used dollar signs for US-based companies, because we wanted to tell everybody that we're using US dollars under the monetary unit assumption. Next is the time period assumption. And the time period assumption looks at making time increments as part of the measurement process. Just like all of us as individuals, when we were born for a long period of time. However, we celebrate our annual birthday. Just like individuals, corporations need to look at set time periods in order to make the information comparable. Our final assumption is the business entity assumption. This assumption tells us that we need to treat business transactions for the company separately from other business entities or the individual owners. We don't want to commingle transactions between business entities or the owners of the company, because we want to know specifically how a business entity is doing. If we commingle the information, it's going to be very difficult for us to determine how a company does on its own.